Welcome, dear traders. You are watching a recap of the Asian session on September 22. It was a hell of a week for some equity markets. Today, Asian stocks declined. Yesterday's close on Wall Street, with the all major indexes in the red, spread the gloom to the antipodian countries. As a result, Australian stocks fell to a 6-month low. Japan's Nikkei posted its biggest weekly decline since last December. Stock markets are suffering heavy losses amid decisions from several leading central banks this week. The Bank of England left interest rates unchanged for the first time in almost 2 years, but left the door open for further increases. Regulators in Sweden and Norway announced rate hikes of 25 basis points, with a prospect of more to come. The US maintained its previous monetary policy unchanged. Switzerland unexpectedly followed its US counterpart. The Bank of Japan announced its monetary policy decision today, and markets were not surprised after the release. The Japanese regulator still adheres to its long-standing ultra-loose policy and anonymously voted for keeping the key rate unchanged at its meeting on September 22. Earlier, investors saw hawkish hints in the statement of the Bank of Japan had, pointing to the end of the regulator's ultra-soft policy. However, at today's press conference, Kazuo Ueda emphasized that there was no change to the way of the policy decision-making process. Meanwhile, the Bank of Japan did not adjust its outlook either. Meanwhile, the Japanese policymakers remain under pressure as the country's inflation rate has been standing above the 2% target for more than a year. According to statistics released today, Japan's annual inflation dropped to 3.2% in August, the lowest level in 3 months. Meanwhile, core prices remain outside the target for the 17th month. Another negative side of the weak yen is the country's subdued wage growth. The fact is that rising wages is one of the conditions for the Bank of Japan to stop stimulating the economy. According to today's reports, wage levels in Japan continued to fall, while they rose to 2.3% year-on-year in June, and they fell to 1.3% year-on-year in July, so the Japanese regulator has no choice but to continue its negative interest rate policy. The Japanese yen also seems to react quite predictably to all the events, and the dollar-yen pair jumped to 148.40 overnight, and this made traders cautious in anticipation of a possible intervention. Moreover, the Japanese authorities say that they are monitoring the impact of currency fluctuations on the Japanese economy. At the same time, they are warning the markets that there will be no green light for unpunished yen purchases. Last year, the intervention took place when the yen depreciated to the level of 152. As for yields on Japanese government bonds, the Bank of Japan's intervention on them was much more frequent than on the national currency, and the regulator has repeatedly bought back government bonds when the yields threatened to exceed 1%. Today, the yen's trading range of 147.5 and 148.40 is still far from the critical level of 150. However, the pair is maintaining bullish sentiment. That means that the dollar-yen pair may increase in the long run. Indeed, the unquestioned winner of the week was the US dollar. After the US Federal Reserve raised the odds of another interest rate hike this year, the greenback surged above 105.5. It's the highest level since early March. And today, the US dollar index continued its rally against 6 of its major counterparts. The greenback jumped to 105.70 overnight on the background of a weaker G6 counterparts, especially the euro. In the Asian session, the US dollar rose within the daily range of 105.30 and 105.80 and prepared the ground for its dense weekly growth. The antipodium currencies also entered the bullish territory early Friday. The Australian dollar rose against the greenback to 0.6433, maintaining bullish momentum. And the strong US dollar and the previous day's decline on Wall Street should have put pressure on the Aussie and sent it down the daily range of 0.6403 and 0.6436. However, the Australian currency soared on the back of elevated oil prices and positive news from China. According to Chinese state media, the country's authorities have outlined a series of regulatory measures to support the country's crippling economy. The upturn in the Chinese market is just as important for New Zealand, and this is especially the case as the consumer sentiment in New Zealand declines due to ongoing price pressures. The same goes for trade. In August, New Zealand posted its largest trade deficit in 10 months. In addition, both imports and exports shrank. At the same time, the country's price level is still elevated, and this means that the Reserve Bank of New Zealand may make another interest rate hike before the year end. As a result, the country's currency grows on the daily chart in the range of 0.5919 and 0.5959 today. JP Morgan's announcement was another major event for investors. The company will include India in its widely tracked emerging market debt index. This sets the stage for billions of dollars to flow into the world's fifth largest economy. The Indian currency strengthened today. In early Friday trading, the rupee pierced the record low of September 19 and dropped lower to 82.80. The dollar-rupee pair declined against a strong dollar and capital outflows. Currency interventions by the country's central bank managed to offset these negative factors. As for the euro-rupee pair, it's trading in the red, and the pair fell to 88.30 at the end of the Asian session. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online next week.